bringing you the latest in tax credit news, insight, and analysis. This is Tax Credit Tuesday with your host, Michael Novogradac.
Hello, I'm Michael Novogradac, and this is Tax Credit Tuesday. This is the September 19, 2023 podcast. We're celebrating a notable milestone here on the show. This is our 800th episode of Tax Credit Tuesday. Hard for you to believe there have been 800 episodes. I want to take a moment to thank all of our past guests and our listeners for the support over the many, many years. And I'll also note, if you're new to Tax Credit Tuesday, welcome. We're happy to have you, and there's no better time to tune in. And I would encourage you to look at some of the past episodes if you want more than one podcast a week. Today's show is also notable in that we're launching a new series on Tax Credit Tuesday. This series is going to focus on a variety of renewable energy topics, with particular focus on financing such facilities. And we're going to start that series with today's show, episode 1 of this new series. The new series is going to go under the banner, the Renewable Energy Tax Credit Finance Series. Today's more specific topic is renewable energy tax credit structuring trends. There have been many, many exciting developments in the clean energy space of late. And this is most particularly related to the enactment of the Inflation Reduction Act last year. The Inflation Reduction Act did a lot of things. In addition, what we want to focus on in large measure in this podcast today is that it created 2 new ways to monetize renewable energy tax credits. What are those 2 new ways? First, as we discussed periodically on various episodes in the past, the ability to transfer certain renewable energy tax credits, almost as if they were separate property. So you hear a lot about transferability of renewable energy credits. And the second is the ability for certain nonprofits to elect to treat certain renewable energy tax credits as refundable, which means that they can file a tax return and get a tax refund for those credits. This approach, this refundability approach, allows a nonprofit to monetize certain renewable energy tax credits in lieu of using the more traditional tax structures. These 2 new monetization options, as well as other market factors, are directly affecting the way renewable energy transactions are being structured today. My guest is my partner, Tony Grappone from Novogradac Andover, Massachusetts office. Some of the top trends in renewable energy tax credit structure that we're going to discuss today include the use of transferability as in lieu of traditional tax equity, as well as the pros and cons of eligible nonprofits electing to monetize tax credits via the tax credit option. We're also going to touch on prevailing wage and apprenticeship requirements and a variety of other things. I do want to note and encourage you to register for the Novogradac 2023 Fall Renewable Energy and Environmental Tax Credits Conference. It's going to be held in Washington, D.C. on November 2nd and 3rd. Tony's going to chair that conference, and we'll discuss more renewable energy hot topics. I'll include a registration link in today's show notes so you can sign up. You can also go to www.novoco.com/events to sign up, or just search in Google Novogradac Renewable Energy Tax Credit Conference. I'm sure it'll take you. Another great resource I think you should consider is the Novogradac Renewable Energy Working Group. This working group seeks to build consensus on emerging tax issues related to the Inflation Reduction. In fact, in August, our Novogradac partners, Nat Ying and Alvin Lee, testified on behalf of the working group, Treasury hearings on transferability and elective pay. So make sure your voice is heard and join the Novogradac Renewable Energy Working Group. I'll also include a link to the working group interest form in today's show. As you can tell, we have a lot of great topics to cover in today's podcast. So if you're ready, let's get started. So Tony, welcome back to Tax Credit Tuesday.
Thanks, Mike. I can't believe it's already been 800 episodes of the podcast series. I remember when you started doing this, and it sort of seems like just yesterday. So it's remarkable that you've done so many of these. I've had the pleasure of being on several of them, and it's an honor to be here on the 800th episode and kicking off the Renewable Energy Tax Credit Finance Series. So thanks for having me.
Well, it's an honor to have you be a guest on the 800th episode. Now, I didn't say much about your background in the introduction, And I do suspect that many of our listeners are very familiar with the work already. You've been a leader in the renewable energy industry for accounting, tax, or related consulting services since the early 2000s. You've really devoted your career to working in the tax credit industry. And as I noted, you're also the chair of Novogradac's annual Fall Renewable Energy Tax Credit Conference. But there's a lot more. You're also a frequent speaker at other renewable energy industry events, just getting back from one yesterday, I believe. And as we've noted, you're also a frequent guest of mine here at Tax Credit Tuesday. But with all of that said, for the benefit of our listeners who are newer to the renewable energy or just tax credit industry more generally and haven't had the opportunity to work with me yet, please highlight some of the services that you provide to clients from Novogradac.
Great. Thanks, Mike. I appreciate it. Yeah. So, here at the firm, I oversee 3 silos of services. One silo is transaction advisory related, where we help clients with running deal models and assisting them with structuring transactions. So that's really the first silo. The next silo I oversee a silo of services related to attestation services. That's really, when you think of that, you're really thinking about financial statement audit services for clients. And then the third silo deals with tax compliance services. And when you think of tax compliance, you're really talking about tax preparation services. And so I get to oversee those 3 silos, which I really enjoy. And then within each one of those silos, there are supported by professionals that really specialize in just those related services. So we've got a team of experts that's focused in those very niche areas. And I get the benefit of working across all 3 of those disciplines, which allows me to really provide great service and value to my clients. And so, yeah, and I just got back from the RE Plus conference in Las Vegas. That's the industry's largest kind of trade show event, and excited to be back here doing the podcast with you, and very much looking forward to our fall conference coming up in November.
Great. Thank you for that. And I do understand that there is a Jeopardy session at that event, but you don't need to share any results, or maybe you can post something on LinkedIn about that Jeopardy session.
That's right. That's right. So that's a hint to how I ended up faring in the Jeopardy challenge. So, yeah. Exactly.
So thank you for all of that. And I do want to dive into the structuring trades discussion. But before I do that, I always like to do a bit of a level set for listeners who might be newer to the topic we're covering in the podcast. And obviously this week is the Renewable Energy Tax Credit Finance area. And for those who are newer to this area, there are 2 major types of renewable energy tax credits. One is a production tax credit and one is an investment tax credit. And as you might surmise, the production tax credit is based on the amount of renewable energy produced and sold to third parties. With that being the production tax credit, when you think about the investment tax credit, you can probably guess that that's based on the costs incurred to develop and construct renewable energy facilities. In some ways, one is about the input, one is about the output. Most commonly, the investment tax credit is used for solar developments. And I would note that the Inflation Reduction Act did extend the investment tax credit from 2022 through 2032 at essentially a 30% credit. So with that foundation, Tony, for our listeners, if you can explain to our listeners the common structuring options and considerations for the production tax credit and the investment tax credit.
Sure. Yeah, great. So I'll try and go through these quickly. So there's basically 3 structures that are used, most often in renewable energy. And I'll talk about them in order of sort of least complex to the most complex. Okay. So starting with the least complex structure, you've got what's known as the sale leaseback structure. And in that structure, a developer builds a project, brings it to completion, and then it essentially sells the mechanically complete facility or even the substantially complete facility off to a bank type investor. And then the sponsor usually leases the operating rights back from that financier. Sponsors tend to like this structure because it is obviously it's sort of like one-stop shop financing. You got one counterparty you're dealing with. So it's less complex in that way. So they raise all of their financing proceeds from one source. So it's kind of easy to understand. In many ways, it sort of looks and feels like a debt product to them. And so it's easy for them to understand, easy to execute on. And so that's kind of popular from that standpoint. That being said, most sponsors also view it as a structure that sort of limits their economic upside. And so from that standpoint, if they've got a project that they think is particularly economically beneficial, then they might sort of gravitate towards these other next two structures that I'm about to talk about. The next structure I want to talk about is probably the most popular structure used in the industry. It's called the partnership flip structure. That involves using a partnership, okay? And the classic partnership flip structure usually involves a two-partner partnership where you've got a 1% pre-flip sponsor member, that's usually the developer, and then you've got a 99% pre-flipped tax equity investor, okay? And then they will have a split mechanism that takes place either upon a minimum yield being achieved or at some prefixed date down the road. Okay, so you've either got like a yield-based flip, where the flip happens when the investor achieves a minimum IRR, or you've got what's called a fixed flip arrangement, where they write into the partnership agreement that at some date in the future, their interest will automatically flip. And the classic flip percentages usually involve the sponsor flipping up to, say, 95%, and then the tax equity investor flipping down to as low as 5%. At that point in time, there's usually a call option period built into the operating agreement that allows the sponsor to basically buy out the investor's interest for its then fair market value. Sponsors, tax equity, or I should say, deal participants tend to really like this structure because it allows the sponsor to get more of the economic upside in the deal than they would get if they just did the sale leaseback structure. It also gives the tax equity investor probably greater comfort that they can get out of the deal once the tax benefits have been fully vested. Okay. And so from that standpoint, that's a very popular structure. And we've seen that for a long time. That structure's been used even way back into the 90s. The last structure we have is called the inverted lease structure, also referred to as the lease pass-through structure. It's the most complicated structure, but it tends to be popular with sponsors because, again, the sponsor's primary motivation is to get the greatest amount of economic return they can get from the transaction. And so this inverted lease sort of helps accomplish that goal. But it's complicated. It tends to be a partnership structure, and you use two partnerships in this structure to accomplish what you can sometimes do with just one partnership with a regular flip. In the inverted lease, you use one partnership to own the facility, and then you use a second partnership to operate the facility. Okay. And, your tax equity investor, interestingly enough, the tax equity investor takes their ownership interest in the operator partnership, oftentimes referred to as the lessee. Okay. That oftentimes confuses deal participants right away because, as you alluded to, the ITC is based off of construction costs. If the owner partnership or the lessor owns the facility and incurs all the eligible construction costs, then why would the tax equity investor take their interest in the lessee partnership? That immediately gets people confused. Well, there's this really unique rule in the tax code that allows participants in a lease pass-through structure to make an election whereby the lessor basically says, I, the lessor, allow you, the lessee, to be deemed to have incurred the tax credit eligible costs and claim the tax credit. And so anyway, it's a very popular structure because it allows the deal participants to essentially bifurcate the tax deductions or the depreciation benefits from the tax credits. And because of that, it allows them to sort of isolate and better fine-tune their investment dollars to the return profile they're looking for. So it's a great structure from that standpoint. But as you can tell just by the way I talked you through it, it's definitely a more complicated structure than the first two I referred to. And so those are your three structures that you see most often in the industry. A couple interesting things to note here. For transferability, you cannot use transferability on that inverted lease structure. Okay? And I think a key takeaway for everybody is that even though there are three structures that you can find in the marketplace, the partnership structure, that second structure I mentioned, is by far the most commonly used in the marketplace.
So would you agree that the different structure, some of the key factors in choice or structures is the desire for the investor to have tax depreciation, the desire for the investor to have the tax credits? Obviously, all of them, they want the tax credits. They all get the tax credits to the tax credit investor, but their desire for depreciation, deductions, tax losses, their desire and willingness to pay for cash flow, as well as the gap public reporting transaction, how that can change among the transactions. Would you say those are the key factors that are pushing structures one way or the other, or is there one or two others that you would say are pretty critical?
So you get a couple things there, right? You got the sponsor preferences and then you've got investor preferences. Okay. The sponsor's goal is obviously to raise as much money as they possibly can from an investor. And so like you referred to, first and foremost, it's the tax credit. That's the most valuable incentive here by far. And so they try to max out the value with the credits. Then after that, the next most valuable benefit here is either the depreciation benefits or the cash flow that the investor can expect to get out of the deal. And so investors, they do value a certain amount of the depreciation benefits. They typically can't get all of the depreciation benefits on a deal. But as you know from structuring tax deals, an investor is limited to a certain degree in terms of how much tax benefits they can get based on their investment size, the amount of capital they get in the deal. But anyway, the investor can use a substantial portion of the depreciation benefits, and that allows the sponsor to raise even more money. And then the investor usually requires some de minimis cash flow to complement their return. And so the investor will also advance capital to the sponsor for the net present value of their future cash flow they're going to get in the form of priority returns.
And how often do you see the gap effects, the generally accepted accounting principle reporting, pushing investors towards one structure or the other?
So gap considerations can be a deal breaker for an investor. Okay, so in renewable energy, there's what's called hypothetical liquidation of book value. If you're an equity method investor in one of these partnerships, whether it's the inverted lease or the partnership flip, you're going to have to apply HLBV. To be honest with you, most investors find that to be a bit of a complicated area of gap guidance. Okay, and so it can be a deterrent for certain investors. And so now under the HLBV method, you have to sort of elect how you're going to account for the tax credits. And depending on which method you use to account for your tax credits can steer you in the direction of either the partnership flip or the inverted lease structure. So at some point, the structure does actually play an important role in the investor deciding either to do the deal or which structure they use.
Well, I'm not going to ask you to go any farther on gap. And, frequent listeners know we've done episodes on the expansion of proportional amortization beyond long-living tax credits and other tax credits and some of the challenges that energy tax credits face in applying that. So I would encourage listeners to go back and listen to one of those episodes. And with you have a gap working group. Did you want to say something? Or
Yeah, right. So I didn't mention proportional amortization in my comments. And the reason I didn't mention that is as most of our listeners do know, the FASB expanded the use of proportional amortization to other types of tax credits beyond low-income housing credits. And so technically, renewable energy investments are a candidate for proportional amortization. You have to meet, certain criteria in order to qualify for proportional amortization. And oftentimes that can be difficult to do on renewable energy transactions. So to be honest with you, most investors still plan on using HLBV. Okay. That being said, they do consider proportional amortization and whether or not they can sort of meet the criteria. If folks are interested in learning more about whether or not they can qualify for proportional amortization, I certainly welcome those phone calls and we can help them figure out and sort through that criteria to figure out if they qualify or not.
it's definitely one of those areas where, initially there was disappointment in the fact it wouldn't be as expansive with renewable energy. But the question that I know we've all been having is how can one restructure in a way to be eligible? So I would encourage listeners to reach out to you as well.
Yeah, there are unique structures. Yeah, there are some unique structures that we've helped some clients explore there to try and qualify for proportional amortization. So we love having those conversations with clients. So, yeah.
So let's now talk a little bit more about transferability. You got a good segue by noting one of the three structures, transferability is an option. And as I noted in the intro, transferability is a new concept, created last year by the Inflation Reduction Act. And Congress's goal was to expand the pool of investors that can claim renewable energy tax credits. And by increasing the pool of investors that can claim the credits, could increase their value. And transferability obviously allows the credits to be transferred in isolation to an investor. which makes it easier for the individual investors to become investors as opposed to participating directly in one of these structures that Tony mentioned. Now, Treasury released in June additional guidance on how to transfer renewable energy tax credits. So from what you're seeing now, how is this transferability option affecting deals that are being structured right now? And feel free to also talk about what you think, how it might affect deal structures in the nearer term versus the immediate term.
Sure. So, obviously transferability is probably the hottest topic from the Inflation Reduction Act. It's having the biggest impact on the industry. And so a lot of optimism on how transferability can just create more liquidity in the marketplace for renewable energy tax credits. What we're seeing right now, we're seeing traditional tax equity structures being used, like the partnership flip. Okay. But what you're seeing is it's partnership flip with transferability or the option for transferability. Okay. So Mike, imagine you're my tax equity investor and we're creating this partnership and you want to be my investor. Well, you're probably going to require our partnership agreement to have a provision in it that contemplates transferring the credits. Okay. And so under our arrangement, what we're seeing right now, and I think this is going to be the structure we see for the foreseeable future, you as my tax equity investor are going to contribute money to the partnership the way you normally would. However, you want the option for the partnership to transfer the credits should you not be able to use it maybe as efficiently as you hoped. Okay. And so that's and there are some deals where the investor is saying, look, I don't necessarily think we're going to need to transfer the credits, but I want that option in the agreement. So let's just get that language in there. So we've got the option should we need it. And then there are other deals where the investor is saying, oh, look, we're going to transfer the credits. That's our full expectation. But I'm going to advance the money to you as if we're not going to transfer the credits. But at some point, I'm going to provide the deal a notice instructing them that we want the partnership to make an election to transfer the credits. And then the tax equity investor actually goes and finds that transfer tax credit buyer and lines up the buyer with the partnership that you and I are involved in. Okay. And so you might source that tax credit buyer and you might provide notice to our partnership that the partnership should now transfer that credit. Now the partnership transfers the credit, so sells some or all of the credits to the buyer. Those purchase proceeds come into the partnership that we're in. And then the partnership distributes the transfer proceeds out, presumably to you or to you and I on a pro rata basis, that type of thing. Okay. And that's the most common structure we're seeing right now. It's a traditional partnership flip structure with a transfer option.
And to what extent are you seeing developers themselves, the sponsors, saying, I'm going to lean into transferability, so I'm not going to bring in an investor, and I'm going to plan on transferring it myself, once it's clear, once it's practical to actually transfer them.
Right. So initially, a lot of developers, when the IRA first got passed and everybody learned that transferability was an option, many developers thought, hey, maybe this is an opportunity for me to just transfer the tax credits and not necessarily work with that third-party tax equity investor. What most have learned since then is that although that is an option, at the end of the day, you probably raise less proceeds in that manner than you would if you brought in that traditional tax equity investor. Because again, if the developer simply just sells the credits to some tax credit buyer without using a traditional structure where they bring in, that tax equity investor, well, the only benefit that's now being monetized is the tax credit. The sponsor isn't monetizing the tax depreciation deductions. They're not getting any advance based on, some share of the cash flow, et cetera. And so, it's an option for them. It just means that at the end of the day, the sponsor is probably putting in more of their own money into the deal. And they also have to figure out how they're going to use all that tax depreciation.
Right. And the
sponsors oftentimes can use some of the depreciation benefits, but as you've seen, these renewable energy transactions, most of the assets get depreciated over an accelerated 5-year period. And so the tax losses can be very significant in those early years. And so trying to use them efficiently can be difficult for most sponsors, which then, so it becomes appealing to them to try to find some investor that can actually advance money to them for those deductions. So anyway, early on, the sponsors were all very excited. Maybe they can do deals without tax equity investors. But what they've learned since then is, sure, they can do that, but it usually means they raise less money, which means they're putting in more money themselves, which erodes their own returns.
There's definitely an overlap between the transferability option and the tax refund option. Think about the fact that if the developer to transfer and the depreciation doesn't get monetized, and then similarly, if the developer were planning on the transfer, unless they could, get a buyer to agree to pay for them before they receive the transfer, right? Cash flow, which we see in the tax refund option. So let me use that as the segue.
I love it.
Into additional guidance released in June, along with the guidance on transferability. There was also guidance on how an eligible tax exempt can elect to receive a tax refund of certain energy tax credits. So now eligible nonprofit have to decide, do I want to monetize tax credit by electing the refund route, or do they want to use a traditional tax credit syndication structure? Maybe you could expand and connect some links, if you will, to our listeners in terms of that, when nonprofits will go down the tax refund route and when you think they'll go down the traditional tax structure route.
Right. Great. So first off, elective pay overall is a huge win for the nonprofit sector here. Okay. Because prior to the IRA, there really wasn't an efficient option for nonprofits to monetize tax credits. So prior to the IRA, if you were a nonprofit and you wanted to try to monetize the tax credit, you would have to create some kind of complicated tax equity structure, which didn't work for many nonprofits. Okay. So the IRA comes around and now provides this elective pay option. And so now, if you're a nonprofit, an eligible nonprofit, and you've got a deal of decent size, or you've got a pipeline of deals that adds up to a decent size, you're probably still better off going through the extra effort of creating a tax equity structure. Okay, because you get to monetize the credit, like we talked about before, the credit, the depreciation, et cetera. However, there are a lot of small nonprofits out there that do these kind of like small one-off deals where going through all that extra legwork and incurring those different, sort of transaction costs to set everything up and so forth doesn't really justify, the added tax equity to get on a very small deal. So I think the big win here is for your smaller nonprofits, gives them an option to at least monetize the credit to a certain degree. One of the biggest sort of negatives, if you will, about the elective pay option, though, not only can you not monetize the tax depreciation benefits, but the timing of when you get the refund is sort of a big disappointment here to many in the industry. So, if you were to use a tax equity structure, the investor puts most of their money in and around the time the deal is constructed and placed into service. With elective pay, you can't get that refund until you file your tax return. So if you're a nonprofit, let's just imagine you're a calendar year nonprofit, which I get most are 630 year ends, but for simplicity, let's just assume you're a calendar year nonprofit. You place your facility in service on January 1st of 2023. Well, with extensions, you're probably not filing your tax return, and most nonprofits, in my experience, file for extensions. All right, so you're probably not filing your 990 until maybe sometime around November of 2024. Okay, and then you get 60 to 90 days, or somewhere around there, for the IRS to actually process your return and get you your refund. And so what's that put you? It puts you almost to the end of 2024. So you're sort of looking at a 2-year gap between when you placed the facility in service and when you actually got your refund. Whereas again, if you use traditional tax equity, you would have gotten the money close to when you placed it in service. So the added carrying cost there on the elective pay can be burdensome. And so again, I think overall elective pay is a big win, especially for your small nonprofits, but it's not the home run that I think everybody was hoping for at first.
I couldn't help but smile a bit when you said after the return's filed 60 to 90 days to get your refund.
It's an estimate. It's an estimate. Okay.
I'll just say that's a optimistic estimate.
Right. Right.
Oh, I won't take the under on that.
Take the over. That's right.
Over as in more than 90.
Exactly. Oh yeah, we saw that. Yeah, exactly. We saw that too with in the old 1603 cash grant program. That's timing of when an applicant would submit to get their grant and when they ultimately got it could be 6-9 months. Yeah. So
And I will make it clear, I'm not saying that as a criticism of the Internal Revenue Service. More, the Internal Revenue Service has to be able to assess the legitimacy of the claim.
yes.
They have
Yes.
they'll have to be assessing the legitimacy of the claim, and doing all that in 60 to 90 days would be quite the challenge.
Agreed. Yep. Point well taken for sure.
So when you talked about the use of transferability versus traditional equity, and that you're sort of seeing transactions out there where they're structured as traditional equity with the optionability of transferability by the investor partner. Do you see those trends changing at all as we head into Q4? Or pretty much
Yeah, I think, well, right now with transferability, the marketplace seems pretty comfortable with flip with the transfer option. And I think for at least the next 12 to 18 months, I think that's going to be the structure that you see for the most part. Right now, the industry seems to be feeling like they understand the rules that Treasury has provided through their guidance. Parties have had time to work through a structure that most people feel comfortable with. Now they want to execute. Okay. And so I think you're going to see a pause on people trying to really like explore and experiment with all kinds of alternative structure options at this point. I think there's some real appetite to execute and get some transactions done. And so I think for at least the Q4 through 2024, I think the structure that you're really going to see is flip with the transfer option. Okay. The one wrinkle that you might have there is the example I mentioned before involves you as my hypothetical tax equity investor, where you contribute all the money and then you get a return of capital with respect to the transfer proceeds. A wrinkle to that you might also see is where you really only advance money for depreciation benefits and cash flow, and instead I go get a construction loan to bridge the actual tax credit transfer proceeds. You follow? So, but it's one of those two options. It's partnership flip with the transfer option. You either advance me the investor either advances the bridge proceeds or the tax credit transfer proceeds, or I bridge them through a construction loan.
So one of them I do want to talk about are the bonus credit. Before I move over to bonus credits, anything else about common structures and transferability you wanted to discuss or share with the listeners?
I think we've covered it. I think that just the important thing for folks to remember is with the inverted lease, you can't use that's a huge one for sponsors, because sponsors love the inverted lease structure. And so one thing that they should just really realize here is that that's no longer an option. As a result, if you're a sponsor that continues to use that structure, you're probably going to see it in the pricing, because what that means is your investor you're taking away the optionality of using the transfer. And if you're an investor and you don't have that option, you just got to think it's going to show up somewhere in the pricing. So,
yeah, optionality is a good thing. And there's lots of talk about creating exchanges. And do you have any take on how quickly it'll be until, assuming because I kind of figure out exchanges will develop, just to how quickly they develop and how efficient they might be?
Yeah, I mean, the marketplace there is evolving pretty quickly. So, you're referring to these marketplaces like online platforms where you've got some tax credit transfer sort of warehouse platforms, if you will. And there are several out there in the market, and some are moving quicker than others. And so it still remains to be seen, how that market sort of develops and solidifies. Some syndicators are trying to put together their own sort of marketplace platform. You've got other groups that are just pure warehouse platforms that are trying to collaborate with investors and syndicators. So it's very much still in a state of flux there.
Yeah, it'll be interesting to see how all that shakes out, but it's good to see the competition.
There's a lot of competition there, and everybody's trying to sort of differentiate themselves and show how that they can add unique value. So,
and the good thing is, at the end of the day, all that competition will simply serve to increase pricing for transfer credits, which will lead to more renewable energy, which is the purpose of transferability.
Yes, indeed.
Let's talk now about bonus credits, both the production tax credit and the investment tax credit. There are bonus credits available. The Inflation Reduction Act created these bonus credits to incentivize activity beyond the activity that would be incentivized by the base, say 30% solar credit or investment tax credit. One of the bonuses is 10 or 20% for qualifying facilities that are located in economically disadvantaged communities or certain qualifying types of properties that serve disadvantaged communities. There's also a bonus credit of 10% if the renewable energy property itself is produced domestically, that is within the United States. That's referred to as the domestic content 10% bonus. And then there's also bonus credits available for projects located in designated energy communities, such as brownfields, areas affected by coal mine or coal generation closures. So there's basically 10 or 20% for certain qualifying facilities, an additional 10% for domestic content, an additional 10% located in these designated energy communities. How are these bonus credits being priced? There's the baseline, say, looking at the investment tax credit, there's the baseline 30% credit. Then though these bonuses could be up to 40% more. How do they factor in the equity pricing?
Great question. So part of it depends on, is this a deal that originally closed pre-IRA? Okay, so there were a lot of deals that closed pre-IRA that met the 26%. Pre-IRA is solar tax. Let's talk about solar, for example, here. Solar was a 26% ITC percentage before IRA. Okay, and then IRA gets passed. Now that project immediately jumps to 30%. Then let's say the sponsor figures out that they're in an energy community. So now it's 40%. That gets priced differently than, say, maybe a new underwriting. Okay. So with the old deal, you've got adjuster language and partnership agreements that had to get looked at. And so some of those agreements had caps on the adjuster provisions. So it might be like, look, well, if the credits go up, the pricing stays the same. But at some point, if it exceeds a certain amount, it's like the pricing doesn't go up or it only goes up by a certain amount. And so we've definitely seen a lot of deals that originally closed pre-IRA where the credit, went above an investor's adjuster limit. Okay, so that pricing there hit a ceiling. Now you've got other deals that, these are deals that are closing after the IRA. Different adders get viewed differently by investors. Okay, so the energy community adder, that has been the easiest one for investors to underwrite and get comfortable with, right? The Department of Energy put out a website. You can sort of go on, type in your address, and figure out if you're in a qualified area. So that one investors are pretty comfortable with. They can underwrite it pretty easy, and so the pricing there can be very similar, the same as non-adder type credits. Okay. Then you get domestic content and the environmental justice adders. Okay. Domestic content can be tricky. You won't know if you met the criteria until after the facility's been placed in service, and you can look back and do a real robust test to figure out if you qualified. So the pricing there tends to be a little bit softer because there's more uncertainty. Uncertainty equals risk, and risk equals higher cost of capital, right? And so the pricing is less on the domestic content credits. With environmental justice, similar kind of thing. You've got developers that are saying we will get an award. With the environmental justice adder, taxpayers have to apply and get awarded that benefit. And so that's all TBD. Nobody has that benefit yet. They still have to kind of open up the application process, et cetera, there. And so on those deals, investors are saying, if you get the award, the pricing goes up by the following amount. You follow me? And so anyway, long story short, the pricing is firmer on the energy community adder, and then less so on the domestic content and the environmental justice, basically because of the uncertainty there.
And I would just add that when you think about these bonus credits for the benefit of our listeners, if you think about the pricing and once again, we'll stay with solar credits at 30%. If you bring in a tax equity structure, the investor is investing based on the credits and the tax losses. And there'll be some pricing on might often be viewed in terms of a per credit equity pricing, but it's really credits and losses. And then if you then increase the credits, you're not proportionally increasing the losses. So from a theoretical perspective, they're actually conceptually going to pay slightly less for those extra credits. It might all get blended in. It may not be teased out, but I just wanted to get a little bit wonky there.
It's good. No, I appreciate you doing that too, because people who are new to this, they oftentimes get confused by the way some of us in the industry just kind of talk about
Right.
transaction terms. It's common where people talk about price per credit and this and that. But really what you're talking about is an investor is sizing their investment. They're sizing their partnership investment. And folks have just said, okay, what's just an easy common way to refer to our investment sizing? And they've done that based on a price per credit. One thing that confuses newbies to the industry is a newbie will say, hey, Tony, what's the price per credit for a ITC? And I'll say $1.15. Okay. And they react and they say, I don't get it. An investor is going to give me more money than the credit's worth. I thought they wanted to make money on the deal. And I have to remind them that no, that's just the sort of industry vernacular in terms of talking about how an investor sizes their investment. The investor is going to contribute at a price per credit ratio of $1.15. But at the end of the day, they're looking to get benefits that exceed that because the benefits are going to be the credits plus the value of their tax losses plus the amount of cash flow they get out of the deal. And at the end of the day, when you add up the basket of benefits they get back, it's going to exceed the $1.15, and they make they have a reasonable expectation to make a profit on the deal.
Exactly.
So, yep.
In the timing of, and then also the timing when the $1.15 comes in, right?
Exactly.
Because in other tax credits, there's oftentimes this cocktail party sort of discussion as what your credit per dollar or your credit,
Right.
your price per credit. And depending on when you get the money, you're willing to wait 10 years to get the money. We're going to hire price per credit.
Yeah.
So what are some of the steps investors are taking to mitigate their risk with respect to these bonus credits? As you mentioned, energy communities, I mean, since it's location specific, a lower level of risk. The other credits have, greater levels of risk. And certainly one step is delay capital contributions.
Right.
So that's one way to mitigate your risk. What other sort of approaches are investors taking?
Right. So investors will oftentimes turn to the sponsor developer and say, look, we would like some level of indemnity from you or your parent company or whatever. So oftentimes there's a sponsor affiliate is providing some degree of indemnity to the investor to provide some sort of, loss protection there. Okay. And then in other situations where we've seen a big uptick here, especially with adders, we've seen investors look for additional protection. And one way that they try to seek additional protection is through the use of what's known as tax position insurance. Okay. There are insurance providers out there that can provide policies that allow for coverage in the event the IRS challenges or disallows credits or disagrees that the credits were valid. And so some investors are looking for protection beyond maybe a sponsor indemnity or in lieu of a sponsor. Say a sponsor indemnity isn't available. Some investors will want tax position insurance. Sometimes they want tax position insurance on top of a sponsor indemnity. But anyway, those are the most classic ways that you're seeing investors protect, in addition to doing classic due diligence, right? And so first and foremost, investors do their diligence. They use third-party professionals like Novogradac and others to vet the merits of a tax position. Okay. So like for domestic content, we might do an agreed upon procedures report where we help a client verify the amount of content, procured in the United States relative to the total amount of components. And right. So we might help investors get comfortable there. With the environmental justice allocation, that should be relatively straightforward because eventually they're going to apply and find out if they did in fact get an award allocated to them. So, but yeah, classic due diligence. And then on top of the diligence, indemnities and insurance.
So there's several questions I still want to ask. I'm going to start merging some of these questions together. So this doesn't become not only our 800th episode, but also our longest episode ever. I'm enjoying the discussion. So I'm not trying to shorten it, but what is it about renewable energy tax credit is it's sort of an as of right for the most part. Certainly the 30% investment tax credit is sort of an as of right in that you get to claim the credit based upon the percentage of your project costs, the general matter not needing to get a special allocation absent some of the bonus where you do. But that then means that, you file a tax return with a certain amount of basis, and whatever you initially projected your basis to be is going to be different. Projections are estimates. And whether you know about a projection is it's not going to happen exactly that way. Hopefully it's close. So the basis will generally be higher than originally projected, in which case there's more tax credits and there's potential upward adjusters, or it could be lower than projected. There could be downward adjusters. And then also under audit, the IRS may come in and challenge some of the costs that were not their eligible tax costs. How does that variability get negotiated among the investor and the sponsor? How does it get reflected in agreements? In a brief answer,
All right, as brief as
longer to answer it than I took that I took to ask it.
All right, challenge accepted. Challenge accepted. All right. So normally, if let's imagine the IRS challenges a deal, and the IRS comes to the conclusion that too many credits were claimed. Okay, and so there's an adjustment. An adjustment ensues. Typically, the order of events there under these agreements and allows the investor to first seek recovery through an indemnity. Okay. And then if there was tax position insurance involved, then usually it's the sponsor who buys the tax insurance policy, and then the sponsor would file a claim to get tax insurance proceeds.
Got it. And then the excess basis on placement in service, they're just adjusters up or down to adjust the equity pricing.
Correct.
I also wanted to kind of take a step back on the nonprofit transactions where we have like the tax refund option, and just, see what you're seeing right now as your structured various transactions. I think we've said that on a smaller size nonprofit transaction, they'll end up going the refundability route because the cost of a monetization structure is too great, and they end up not being able to monetize the depreciation. But it's not practical to monetize the depreciation as well. Larger transactions, they'll likely get down the traditional tax equity route because of the ability to monetize their depreciation. Will you just say, yes, that's about it? Or is there additional nuances you'd want to share with the audience?
Just that if you're a nonprofit, when you want to use a traditional tax equity structure, that usually involves creating a for-profit subsidiary that's going to take the ownership interest in the facility. Okay. Otherwise, if you're a tax exempt entity and you own this type of property, that can result in reductions to the actual eligible basis and tax credits. So
that's a critical structuring point.
Absolutely. Yeah.
Tax as used property.
Exactly.
And do you think over the longer term that'll change, or do you think that there's nothing really? Because when I look at it, it's like, I'm not sure there's something out there that would cause what the advice we're seeing or what we're seeing now to really change over the longer term, because there's nothing to be learned that cause it to be something different.
I've got one large nonprofit renewable energy client, and they're continuing to sort of like vet and consider what other alternatives they might have. But I can tell you, we're working on some closings with them right now, and they're using the traditional partnership flip structure the way they always have.
So maybe one last topic on this structure related, not really structure related, but as I mentioned in the introduction, the Inflation Reduction Act essentially requires most renewable energy facilities to meet prevailing wage and apprenticeship requirements. And I say requires because the statute works in a kind of complicated way that says basically your credit could be, say, 6%, but if you meet prevailing wage and apprenticeship requirements, it's 30%, say for a solar property. Everyone basically operates. I don't know if anyone doing a 6%.
Not yet.
Operating, not like these are bonus credits that you operate as if it's a requirement. Our size requirements, it's not all have to meet them, but most do. And in preparing for the podcast, I talked about how renewable energy developers and contractors, generally speaking, have policies and procedures in place to satisfy these apprenticeship and prevailing wage requirements. That's Treasury did recently release guidance on prevailing wage and apprenticeship requirements. So if you could share with listeners what you think some of the key takeaways from the guidance are.
Right. Great, thank you. Yeah, some of these labor rules can be sort of complicated and nuanced, and I think one thing that's key for clients to realize is the IRS and Treasury did provide proposed regulations back at the end of August, and as part of that, they also made it clear that if you're struggling to know what you should be paying laborers under the Prevailing Age Act or under the Prevailing Wage rules, the IRS provided a website. You can go to sam.gov, and if you go there, you can, based on the location, et cetera, and the type of labor, they provide the labor rates that you should be paying your laborers and contractors. So, some people use the terms like Davis-Bacon and prevailing wage somewhat interchangeably, and I think that can sometimes be confusing depending on where your project's located and what sort of rules you're subject to in that local area. I would just stress to people, go to sam.gov. The IRS and Treasury provided that portal for you to figure out the appropriate rates to use. Take advantage of it. If you have additional, and if this is something that really matters a lot to you, if it's near and dear to you, and you've got additional comments, let us know. As Mike mentioned at the beginning of the call, we do have this renewable energy working group, and we, as part of the working group's effort to help the industry, we provide comment letters to the IRS on all kinds of topics. And one thing that we're focused on right now is submitting additional comments to IRS and Treasury on the prevailing wage rules and guidance. And so if you've got some questions or you got some comments that you want shared, please reach out to us, and we'd love to get your thoughts and comments and work them into our comment letters that we submit to the IRS and Treasury in the coming weeks.
Great. Thank you for that, Tony. They're going to bring this to a close, or at least this part, unless there was something else you wanted to share. Great. So do stick around for our off mic section. I'm looking forward to asking you a couple of off-topic questions, share some recommendations and words of wisdom with me and our audience. And to our listeners, please tune in to next week's episode. We're going to have another installment in our popular So You Want to Be a LIHTC Developer series. My partner, Meow Sue, will be my guest, and she's going to discuss the importance of financial forecasts when you're developing residential rental housing that's being financed by low-income housing tax credits and tax-exempt bonds. More particularly, Meow is going to discuss some of the common mistakes that she sees in developer prepared forecasts. And obviously, to the extent you can avoid these mistakes, you're likely to get slightly higher equity pricing and also avoid recapture events or surprises in gap financing needs. If you have any questions you want me to cover in that episode with Meow, please email me at cpas@novoco.com. Okay, Tony, now we turn to the off mic section where I get to ask you a couple of questions unrelated, at least not directly related to tax credits. I know that some of our regular listeners know of your musical talents. In the past, you've been on, and we've actually posted one of the songs that you produced, and we'll do that again on this episode. So you have to send me one that I can link. So obviously, I'm pointing out that in addition to being a great accountant and tax credit expert, you're a gifted songwriter. So do you have advice for someone looking to pursue a creative outlet outside of accounting and tax and project finance? Because there are definitely creative outlets, and I'm sure there's overlap between your songwriting skills, project finance skills, but other thoughts on how to pursue a creative outlet?
Yeah, I would say, when it comes to creating things like art, like songs and other forms of art, it can be very intimidating, right? I mean, when you create art, it's a very personal experience and it can feel a bit vulnerable. And I think a lot of business people oftentimes are uncomfortable of opening up in that sort of manner. But I think one of the things I've learned through, creating art like songwriting is it sort of like helps with relationship building. Because as you share whatever that creative thing it is that you came up with, as you share that with others, it's a very personal experience and it gets others to know you in a very authentic kind of way. And that leads to creating deeper bonds and closer relationships. And we both know that in business, a key part of success is being able to create great relationships with the work colleagues. And so one thing I just say is, as people think about approaching some sort of creative outlet, I'd say, look, it can be intimidating, right? To open yourself up in that kind of vulnerable manner. But I'd say don't be afraid. Like a lot of things in life, don't be afraid to try and even feel like you're sometimes failing a bit. But take that leap, and I think you'll find that not only do you get a lot of joy out of the art that you create, but I think you'll find how it improves the way you create relationships with others.
Very well said. I'm going to remember, don't be afraid to try. Words
So,
right. So
yeah.
my second question just deals with upcoming Novogradac conference season. I noted in the introduction, you mentioned as well that you're the chair of the upcoming Novogradac 2023 Fall Renewable Energy Conference in DC, and you're very experienced at attending conferences. What's some of the advice you have for helping attendees at our conferences or other conferences maximize the benefits that they'll get from attending in person?
Great. Yeah. So if you're new to this conference, I definitely recommend, go to the website and look at the agenda and see who the panelists are. If you're not connected with them yet on LinkedIn, I recommend connecting with them in LinkedIn in advance of the conference, and maybe shooting them a note and saying, "Hey, it'd be great if we could meet at the event." Okay. I would also download our Novogradac Events app and use that to network and communicate with the panelists and other attendees. The other thing is when you're at the event, at the end of each session, I really recommend going up and doing just a quick introduction to the panelists. Okay. It's hard to meet them all, but maybe find the ones that, relate to you the most or can complement whatever you do the best, and just quick hello, thank them for their panel content, that kind of thing. And maybe see if there's a way you can sort of catch up later at one of the networking or reception events. Okay. So that's what I would recommend there. And if going to events is new to you and you're uncomfortable meeting people, come find me. I love meeting attendees. I like to learn about where you're from and what you do. And if there's folks you're looking to network with there, let me know who they are, and I'd be happy to help connect you with others there too.
Thank you for that, Tony. And I definitely think downloading the app, that's probably the most underused resource in advance of going to one of our conferences, because you can go and download the Novogradac app. It has a list of attendees, including all the speakers, and you can connect with them through the app. So, so it's definitely a way of seeing who's going to be there and sort of pre-networking.
Absolutely.
My kids taught me about pre-partying. So you can download the app and connect in advance. And I would also encourage you to, if you go to the Renewable Energy Conference, take a moment to introduce yourself to Tony. I'll be there as well. And I encourage you to take a moment to come up and introduce yourself to me as well. So thank you, Tony. I'm looking forward to having you back for another Real Energy Project Event Series episode sometime in the near future.
Anytime.
I'm Mike Novogradac. Thanks for listening.
And now here's Goodnight, written by Novogradac partner and Tax Credit Tuesday guest, Tony Grappone.
My phone, it don't ring as much as it used to. All those late night texts to come over, well, I guess that's all I'm good for. Now I'm lying here and feeling just like a fool. Now it's good night to all my dreams of us, like waking up and so in love with you for life, like I dreamed of. It's just good night. Yeah, it's good night to dreams that felt so real, like someday you and I could be more than late nights, just fast love. Now it's just good night.
I tried to lie myself into thinking I could change.
Yeah, well, you can't fake what you can't feel.
I wanted to